Great, thanks. Fortunately, Steve talked about the law because I'm not a lawyer and don't even play one on TV. But I do want to talk a little bit about China as a currency manipulator, but in particular, just talking about currency manipulation as a concept a little bit. So does it matter? You know, how should we judge it? And then lastly, is China a manipulator, with a little bit of commentary on what's been said in the last week. I really do have to thank Mike Moore for asking me to talk about this. When I agreed a few months ago, well, I was very busy at the time, so I was agreeing to anything starting in February because I was like, I'll have so much time by then. It'll be easy, but it didn't occur to me how hot a topic currency manipulation would suddenly become the week before this conference, with kind of constant commentary both from the Trump administration and responses from world leaders to comments coming out from the Trump administration about currency manipulation. So does currency manipulation matter? I'll go ahead and say yes, in the sense that for it to matter, you need two things, right? On the one hand, you need exchange rates to actually matter. And so I'll just take that as given. Plenty of research, exchange rates affect trade flows. So yes, we'll take that. The second one's a little trickier, right? Because what you need to say is that it's unfair to sell something to someone too cheaply. Economists really struggle with this one, right? So because it's like, why is that bad? Like, shouldn't I say thank you if you want to sell me something really cheaply, right? But on the other hand, for all the trade policy folks in this room, it's a given, right? Yes, it's completely fair to be upset with someone for selling you something too cheaply. And so we kind of have to just take that one as given, but it's also not, you know, joking aside, there are some reasons for that, right? Mike talked at the start this morning about the adjustment costs that can take place. And you don't need to put too much into your models about some fixed costs, some fact that, you know, there are dislocation costs to shutting industries down and opening them back up, that if one country is acting in a predatory manner, that can have big spillovers to somebody else, and we may be worried about that. And so if we take this as we may or may not, we may care about manipulation, the question becomes, then how are we going to judge this? Because the first thing to remember is almost everybody manipulates in one way or another. So these pictures are what percent or what share of countries fix their exchange rate. Right, so half the world's countries at any given point in time have a fixed exchange rate. The blue line is how many of them have ever done it during this sample, and you get up to like 80%. Right, so everybody manipulates their currency. So you can't just start with the fact that you're altering the value of your currency in some way. You got to do something more than that. The other thing is you can't just say the currency's undervalued, right? Because you have to remember how much freely floating exchange rates move. They can move 20, 30, 40% in a given year, at which point certainly someone was undervalued at one point and someone was overvalued at a different point if the currencies are swinging this much, right? If the dollar yen was 80 and then was 120, it's very hard to believe that one of those two was the wrong price at some point and someone had an undervalued currency. So you can't just use undervalued currencies either. So in some sense, you need both, right? You need to say that you're manipulating, you're doing something to affect the value of your currency, and it's also, in some sense, unfair or undervalued. And so this is, in fact, what Congress has said is consider whether countries manipulate the rate of exchange between their currency and the United States dollar for purposes of preventing balance of payments adjustment, right? So you need both of these two things happening together. So how do we actually operationalize this? For a long time, Congress said there were really just two stories here. You got a global current account surplus and a significant bilateral trade surplus with the US. And then there was no fixed rule as to how to judge either one of these things. So in 2015, Congress said basically the top two again, but then added this point Steve mentioned of the persistent one-sided intervention in the foreign exchange market. And this time, actually, the Treasury Department wrote down what all three of these things mean. So you can go to the appendix of the currency report from a couple of years ago, and they tell you very explicitly a bilateral trade surplus of at least $20 billion, a current account surplus of at least 3% of GDP, and net foreign purchases of foreign currency totaling at least 2% of your economy's GDP. And so what I want to think about a little bit is, does this make any sense? Are these rules that we should think are the right way to think of it? Before I do that, though, first I just want to check, will this net actually ever catch anyone? Right? So two reports have gone through and no one's been labeled a manipulator yet. right? So is that by design? In some sense, you start to wonder. So the first thing to remember is that bilateral surplus of 20 billion has one very handy feature, which is it screens out almost all the countries in the world, right? Because they're too small, right? So if you're a small country, you're never getting caught in this net. There are actually only 19 countries that have exports to the US of $20 billion. So we would have to not buy anything from them to even get over the threshold. So every other country has no chance of being caught. At that point, there are actually 10 countries that have a bilateral surplus of $20 billion, and actually 3 of them don't have their own central bank because they're in the euro, so they're never going to get caught on the currency intervention side. And so you're actually just down to looking at 7 countries, which on the one hand, given resource constraints, makes Treasury's job a little easier. And so you're just left with this small group of countries, and as I said, no one's been labeled. So you might think this was deliberate, but on the other hand, actually, if you go back and look at the last 20 years, this would have caught a bunch of countries at different points in time. So I'll have to double check, because Steve said 03, and I trust Fred's numbers more than mine, but I had China from 04 to 2010 would have failed this test every single year. Every report, we would have been labeling China currency manipulator. Japan for a couple years. Vietnam actually would have hit once. Korea, if you let me inflation adjust that 20 billion backwards so it's smaller, would have been hit in 04. Malaysia for a couple years. But on the other hand, there's some countries that are just almost never going to get caught, like Mexico, because they persistently run a trade deficit in aggregate. So regardless of the bilateral with the US, they're never going to fail that current account surplus thing. So maybe this is a net that would work, and we should then think about, does it make sense? So the first thing I'm going to say is no, because the bilateral surplus has no place here. If I could ever convince anyone of anything, it's that we could please quit looking at bilateral surpluses and deficits as a way of keeping score in a trading relationship. I always tell my students when I first teach, kind of like in the first day of class, when we're talking about these things, I say, I've run a bilateral deficit with my barber for my entire life, and yet they never bought, I go to them, I pay money, they never buy an economics lesson from me, and so clearly I should boycott them or complain about their prices in some way. But, joke is, I mean, it's clear this is a thing that we shouldn't be thinking about the bilateral surplus as this incredibly important thing. Even if you believe the aggregate trade balance has important effects here, the bilateral is really not the right way to think about it. There are a couple of reasons. First of all, the data, right? You get transshipment issues, it really does look like we're counting imports from the Netherlands or Hong Kong, but not exports to them in some cases, because it depends on are you actually looking at China or Germany is the ultimate recipient in some cases. So there's a whole question of how much your trade is actually value-added you're doing versus you bought a lot of inputs from someone else and then shipped the final product. And so you're going to get a lot of things that are just messy. But then there's just also this point of general trade patterns where there's some countries that make things that we want, and there are some countries that want things that we make. We run a bilateral surplus with Australia constantly. It's been around $15 billion forever. Now, when you think about it, $15 billion from Australia's perspective is a huge bilateral surplus from our part, a huge bilateral deficit from theirs. When I worked at the CEA, one of my jobs would be sometimes to meet with foreign officials, finance ministers, etc. I met with Australians many times, and I can tell you never once did they come in and pound the table talking about this massive deficit they were running with us and how mad they were at us. They were perfectly happy to buy Caterpillar machinery to dig up minerals to sell to China, right? And so the point is just it's a pattern of trade question, and the bilateral surplus or deficit is really just something that makes no sense for us to consider. It's useful for Treasury to have this threshold because, again, it clears out all the small countries, but it's something that's just not the way we should be thinking. I think it's problematic partly, and I don't blame Treasury here, actually. I mean, it's explicit from Congress that they're supposed to be looking at it, but I think, sets this mindset that the bilateral surplus or deficit is a way to keep score. And if we could get away from anything of all this stuff, that would be the thing that I would wish we could. And just lastly, the point is, you could have every country having balanced trade in aggregate, and they would still be running some bilateral surpluses and some bilateral deficits just based on trade flows. And so it's not something that's really should be interesting or important to us. The intervention one makes a little bit more sense, right? You start saying, well, a country is trying to prevent the currency from being at the price that the market would push the currency. And so it feels like that sounds a lot more like manipulation. There's a little bit of a problem here, which is that, often countries like to keep a certain amount of reserves to back their banking system. And so if they're growing really fast, right, or if their banking system's expanding, they're going to buy more reserves just because they want to hold more reserves. And so if you have reserves to GDP of 30% and you're growing at 8% a year, granted very fast, but you may think of a country in particular that was growing at that rate, your reserves are going to be going up by over 2% a year automatically, just to keep your reserves ratio constant. And so there's a little bit of concern here that this is a problem, as you're going to catch countries for the wrong reasons sometimes. But a bigger concern to me is that you don't need to intervene to manipulate your currency, right? You can use your capital controls, you can use signaling, you can use a whole range of policies to try to affect the value of your currency. Focusing on the intervention in some ways doesn't help us because it's neither necessary nor sufficient to say that you're manipulating your currency in a bad way. Now, the aggregate surplus, though, I'm actually far more sympathetic here. So amongst big countries, if you run a big surplus, that means someone else is running a deficit, and vice versa. My borrowing is your lending is my borrowing. That doesn't mean you're doing anything necessarily wrong, but it does mean maybe we should be thinking about whether my deficit and your surplus are accomplishing the goals that we have, acknowledging that there are going to be spillovers. I've done work where if you look when there's a shock to U.S. savings, a plausibly exogenous shock that we calculate various ways, roughly half of that spills over to the rest of the world, right? And you can think of that operating in the other way. If China decides to save a lot more, that's going to change world interest rates. That's going to lead to more borrowing from us. In particular, you might worry about this when a lot of countries are at the zero lower bound, right? Because if one country saves more, you might say, well, as long as I can lower my interest rate, then I can offset the aggregate demand hit. But if I can't lower my interest rate, I might really worry about this. And I might start to think that in some sense, aggregate demand becomes in short supply, if you will, and that I worry a little bit about, a country saving too much and producing more than they consume because then suddenly someone else is consuming what they're producing. So you could worry about this in some ways, but it's really not clear that currency is the thing you want to focus on entirely. So you could look at Germany as this recent example. Peter Navarro is quoted as saying Germany is using a grossly undervalued euro to exploit the U.S. and its trade partners. Merkel very quickly pointed out, she's like, look, the European Central Bank is independent. We don't have our own currency. We're not doing anything to affect the value of the currency. And so they clearly aren't manipulating the currency in any given time. Now, and that's true, but that doesn't mean their macro policies haven't been somewhat non-cooperative in the global sense. Right? Many, many people, including, frankly, the Obama administration for the last 8 years, have been complaining about Germany's macro policies, saying that they're running too big a current account surplus, that it has negative spillovers to the rest of the euro area and to the rest of the world, and that they need to provide more aggregate demand to the world and to rebalance things some. And you could look at Jerome Zettelmeyer's response to Navarro's quotes in a Peterson piece the other day, where he pointed out, look, if it's really the currency, then you have to think about what you're asking Germany to do. You're basically saying you have to get out of the euro. And that doesn't seem like the policy that we're going to demand or ask or reasonably get. On the other hand, at the same time, he's saying, as the former economy minister from Germany, he's saying, yes, I agree. Our macro policies were non-cooperative and unhelpful. And if people want to put the pressure on us, that's where they should be putting the pressure, rather than kind of distracting everything and saying it's a game of currencies when it's not currencies. So then lastly, China. Is China a manipulator? Well, it certainly has a bilateral surplus with the United States greater than 20 billion. And the current account to GDP has been floating around 3%. So in a given period, it probably qualified there. But they've been intervening to prop up the RMB, not weaken it. Right? And so in that sense, they clearly fail the test. If Treasury were to try to employ the rules as they've been designated by Congress, there's no way they can label China as a currency manipulator right now. But then just to point out why these may not be the right rules, it's not clear that's the right evidence. Because once again, messaging and macro policy can do a lot to what your currency looks like. right? One of the most important things in the RMB dollar relationship was around 11 months ago or so when a number of Chinese officials finally came out and said, after China's currency had been depreciating, came out and said, we actually don't want it to depreciate too much. If there's a shortfall in demand, we will provide domestic demand to try to meet that shortfall. We don't intend to use exports as the only way to generate growth. And that stabilized the currency. Right? The intervention isn't the whole game here. And so when we only focus on intervention, we kind of miss what should be, where our focus should be. And our focus should really be on the macro policies. And so what worries me about the whole debate around currency manipulation is I think it distracts us from the key questions that we should be focusing on, which is, are the macro policies of the major economies operating in a way that is heading towards some more cooperative outcome? Now, the problem with that is it's then very hard to say, so what do? You know, as I said, we've been asking Germany to spend more. We were asking Germany to spend more when I was at the CEA in 2009 and 10 and 11. And then when I got back in 2015, we were still asking Germany to spend more. You don't have a lot of levers there. On the other hand, as Steve pointed out, even the currency manipulation stuff isn't like you're getting a lot of levers there either, right? There's real, you know, in some sense, you label someone a manipulator and so you have to talk. If anyone thinks we haven't been talking to China about their currency for the last 8 years, you're crazy. There's not a single phone call between Jack Lew and his counterparts or between Tim Geithner and his counterparts that didn't include some discussion of the currency, right? And so saying that, you know, the big penalty is now we're going to talk, again, seems to me that the whole game around the currency manipulation labeling just puts a focus in the wrong place. Now, it's true. If there were other aspects of that rule, if currency manipulation meant you could include currency as part of countervailing duties or things like this that aren't in the statute right now, then this would be a really big deal. But instead, I think in many ways, it winds up being a distraction just because us telling Germany they're manipulating their currency is just not the start of a helpful discussion in terms of changing anyone's behavior. And so again, if you look at what's been going on lately, the complaints from the Trump administration have very much been around our big bilateral deficits, right? It's been Mexico, it's been China and Japan. The president had comments referenced before. Look what they've been doing over the years. They play the devaluation market. So these are the countries that we have the 4 biggest bilateral deficits with. But in many ways, that's not who we should necessarily be focused on because none of them are going to meet the currency manipulation statute. Germany can't intervene. China's intervening the wrong way. Japan's not intervening. And Mexico has an aggregate trade deficit. So we're never going to label anyone if we're following these rules. And in some sense, it's likely that the currency manipulation is the wrong debate to be having. And instead, I would argue it's likely always a dead end. Many of the rules that we've set up to screen are either going to catch the wrong countries or not catch the countries that are actually sometimes playing in some sense, a non-cooperative game globally. The real issue is macro policy. I don't want to say exchange rates are unimportant. They're often a very useful symptom. You could look to see that a country looks like they have an undervalued exchange rate, and that is likely a signal that something in their macro policies is problematic, and the same thing as looking at the size of their aggregate surplus might be. Certainly not looking at the bilateral surplus or deficit, but looking at the aggregate flows. If the dollar is too strong, it's likely a symptom of misaligned macro policies, and you should be attacking that, not trying to focus on is any one country manipulating the bilateral currency with the United States, because that's just not the most important thing. And again, if the penalty is we talk, that doesn't seem like the most crucial thing either, because we're already doing that. So that's where I'll stop.